Good afternoon, everyone. We'll start with banking specialization, second subject in fourth semester, and MBA, that is financial institutions and markets. This is the second subject we have. We've already completed financial risk management. Uh, so, if you look into the syllabus, Unit 1, it talks about overview of Indian financial system and financial market, financial sector reforms, Reserve Bank of India, SECB, insurance companies, NBFCs, and Indian mutual funds. So these are the seven topics we have in Unit 1 of Indian financial institutions. Let us start with the syllabus. Now, the overview of Indian financial system can be easily depicted by this chart, where it is talking about Indian financial system consists of financial institutions, financial markets, financial instruments, and financial services. And then financial institutions, there are two types of financial institutions: banking institutions and non-banking institutions. In banking institutions, we have commercial banks and cooperative banks. Commercial banks can be public sector banks like Punjab National Bank, State Bank of India, private sector bank like SDFC Bank, regional rural banks, and foreign banks. Then we have non-banking institutions, where we have development financial institutions and non-banking financial entities. Development financial institutions are development banks. We used to have the concept of development banks before, and IDBI, ICICI, they all came as development banks. Where as SECB is there, we've got NABARD. They all are development banks. They all like NABARD. It is responsible for the development of agricultural and rural development. Then we have got investment institutions like LIC, GIC, UTI, Life Insurance Corporation, General Insurance Corporation, and Unit Trust of India Limited. Unit Trust UTI is the first mutual fund company in India. Then we have got some specialized institutions as well, which take care of some specialized sector like IDBI, Industrial Development Finance of India. Then we have got SDFC. We had SDFC before this, which was known as Housing Development Finance Corporation. Non-banking financial institutions can, the second arm is non-banking financial entities, which includes NBFCs, non-banking financial companies. They are mainly for equipment leasing, hire purchase, investments, loans, and regional NBFCs, where they have got MBFCs and MNBCs. So this is their non-banking institutions. Then if you look into financial markets, it can be of two types. It is of two types: capital market and money market. If you look into money market, it can be called money market, treasury bills, commercial bills, commercial papers, and certificate of deposits, that is CDs. If you look into call money, there's another concept known as notice money. Anything which is less than 14 days is notice money. Anything which is of 14 days, it is call money. Any loan, and how it works, money market, how it works is like some firm having surplus fund and some firm having a scarcity of fund. Then the funds can move from surplus to scarce. Then treasury bills, T-bills, they are of 14 days, 91 days, 182 days, 364 days. Treasury bills are there. Treasury bills are the bills which are traded by Government of India, which to raise funds. Then commercial bills are there, like accepted bills or non-accepted bills. And commercial papers are there. Commercial papers are negotiable instruments issued by corporates to raise funds. And certificates of deposits are there, which are also form of corporate deposits. Then capital market, we've got primary market where your securities, your shares are issued for first time. Then we have got secondary market where they are traded, like in secondary market comes the stock exchange. And then we have derivative market, which is like swap market, forward market, future market. That is all derivative market. Now let us come to financial instruments. If you look into financial instruments, they have been divided on the basis of two types. First is term, short term, medium term, and long term. Any instrument which is for less than 1 year is short term. From 1 year to 3 years it's medium term, and more than 3 years, if any instrument is there, then that is long term. And if you look into types, primary securities, secondary securities, equity, preference, debt, innovative instruments. Now primary securities are securities like IPO, which are issued for first time. Secondary securities are securities which change hand and which are traded, which have already been issued. Then innovative instruments are the instruments which are made up of both equity and debt. If you look into financial services can be divided into asset or fund-based services, and second one is fee-based services. Asset or fund-based services can be divided into leasing, hire purchase, consumer credit, bill discounting, venture capital, housing finance, insurance, factoring. These all services involve funds, movement of funds. And fee-based services, which are services provided by expert institutions to the companies or corporates, like merchant banking, credit rating, stockbroking, mergers, and they charge commissions for these services. So this is the overview of Indian financial system in component of Indian financial system. Financial sector reforms. If we look into the emergence of financial sector in India, it can be divided into 18 parts. First one is indigenous bankers. From the time immemorial, there were indigenous bankers in India. Indigenous bankers means bankers who were not regulated, like we used to have sahukars and zamindars before we used to lend to the farmers. Then in Kautilya Arthasastra, we get the reference of finances, and the importance given to finance was very important in Kautilya. It is also a book or treatise on economics. We had three presidency banks during British era: Bank of Kolkata, Bank of Bombay, and Bank of Madras. They were presidency banks. These three banks were combined to form Imperial Bank in 1921. Through Government of India Act, through Reserve Bank of India Act of 1934, Reserve Bank of India Act came in 1935. After independence, Banking Regulation Act was enacted in 1949 to regulate banking sector in independent India. There emerged various development banks like IFCI, IDBI, SFC, and ICICI to develop very specific parts of the economy. Like IFCI, it is Industrial Finance Corporation of India Limited. IDBI, Industrial Development Bank of India. SFC, State Finance Commission. ICICI is Industrial Credit something. ICICI, it was something Industrial Credit something institution. Then in 1955, State Bank of India, the Imperial Bank of India, was renamed as State Bank of India. It was nationalized through State Bank of India Act of 1955. Then nationalization of banks took place in 1969 and 1980, and 19 of the banks which were not nationalized before were nationalized, and they were converted to government banks. LIC came in 1956, General Insurance Corporation in 1972, and UTI in 1964 to drive the investment avenues in our country. The Narasimhan Committee on Financial Sector Reforms recommended various measures to improvise or modernize the banking sector in India. SECB was formed in 1989 to regulate the capital market in India. IRDA is Insurance Regulatory Development Authority, responsible for the development and regulation of insurance sector in India. Liberalization of financial sector took place, which led to emergence of various new generation banks and various foreign banks in India, like ICICI Bank, SDFC Bank, Standard Chartered Bank, Barclays Bank. Digital era and its impact on financial sector. Now, the banking moved from door to door banking to digital banking. Net banking took the main stage. Basel norms this is not base, this is Basel norms compliance. According to Basel norms, the capital has to be maintained according to the risk-weighted asset carried by the bank. And the new era is consolidation phase, which is present phase where various institutions are merging together to are getting consolidated to become more fundamentally strong. So these are the 18 stages in which the financial sector reforms in India can be divided. Now let us go to Reserve Bank of India. Reserve Bank of India was established on April 1, 1935 under RBI Act of 1934. It is a central bank, regulator of banking sector in India, bankers bank, government's bank in India. Role of RBI, it is a bankers bank. It means if any bank needs any fund or they want some kind of banking services for themselves, they go to Reserve Bank of India. Government bank. The government of India has Reserve Bank of India in the form of its own bank. The Government Bank of India also issues various securities to Reserve Bank of India. Issuance of currency. Reserve Bank of India is also responsible for the issuance of currency in India. It is a central bank. It is a bank which is a regulatory, which is the bank under whose umbrella other banks are functioning. Lender of last resort. In case all the banking sector loses, if some banking company wants some funds, then they can ask Reserve Bank of India in the form of loans to be given. Monetary policy management. Reserve Bank of India is also responsible for the monetary policy measurement in India. It plays a very decisive role in regulating the liquidity and inflation in our country. Foreign exchange reserve management. Reserve Bank of India also plays very important role in management of foreign reserves in India. Regulation of banking sector in India. Reserve Bank of India is the regulator of banking sector in India. It issues various guidelines and is responsible for the proper functioning of the banking sector in India. It promotes inclusive banking through various measures like agricultural loans, priority sector lending, margin requirements, and leads to the development of Indian economy through properly making sure that the funds are moving in the proper direction to the area which is lacking in funds. So here we come to end of Reserve Bank of India. Now let us go to SECB, that is Securities and Exchange Board of India. It was established on April 12, 1992 under SEBI Act 1992. The preamble of Securities and Exchange Board of India describes the basic function of the Securities Exchange and Board of India is to protect the interest of the investors in securities and to promote the development of and to regulate securities market and for matters connected therewith or incidental thereto. State Bank of SEBI, Securities and Exchange Board of India, is the regulator of capital market in India. It plays a also very important role to educate brokers and investors. The major function of Securities Board and Exchange Board of India includes safeguarding the interest of the investors, especially retail investors, to check frauds and malpractices. It leads to and guides the development of capital market, licensing brokers who can trade in various securities markets, regulation of merchant banking services, and issue guidelines for the effective functioning of the capital market. Insurance companies. Insurance is a contract represented by a policy in which an individual or entity receives financial protection or reimbursement against the losses from an insurance company. The role and the functions of the insurance company is to indemnify, means to protect one against some kind of injury or danger, provide certainty of cash flows. They provide protection, risk sharing, prevention of a loss, Statutory requirements. Why statutory requirements? For example, there are various places where the government asks you to go for some kind of insurance, like third-party insurance of drivers, vehicles. Provides capital. It provides capital to the required sector in economy. It improves efficiency and helps in economic progress. There are two types of insurance: life insurance and general insurance. Life insurance can be term life insurance, money back insurance, unit linked insurance plan, and pension plan. Term life insurance means the insurance in which we pay a small amount for the tenure, and we get protection for our life, but we don't get the money back which we have invested. In money back policy, whatever we have invested, we get that back. Unit linked insurance plans are the plans which are linked to the stock market or to the units or to the mutual fund, on the basis of which this insurance is paid, and also it leads to the appreciation of capital through investment in securities market. Then pension plans are the plans which do finance the pension of the employees. Regular investment plans there. General insurance is the insurance which is not life insurance, like fire insurance, motor insurance, marine insurance. They all are general insurance. What are the kinds of general insurance? Motor insurance, health insurance, travel insurance, home insurance, fire insurance. We already know about these types of insurance. Anything which is not life insurance is general insurance. Now let us look at some insurance companies. We have these are some of the insurance companies we have in India. Let us learn about Life Insurance Corporation. Life Insurance Corporation of India is an Indian state-owned insurance group and investment corporation owned by Government of India. The Life Insurance Corporation of India was founded in 1956 when the Parliament of India passed Life Insurance of India Act that nationalized the insurance industry in India. Over 245 insurance companies and provident societies were merged to create the state-owned Life Insurance Corporation of India. General Insurance Corporation is the general insurance player, and it is a state-owned enterprise in India. It was sole reinsurance company in Indian insurance market until the insurance market was open to foreign reinsurance players by the late 2016, including companies from Germany, Switzerland, and France. GIC RE has its registered office and headquarters in Mumbai. The entire general insurance business in India was nationalized by Government of India through the General Insurance Business Nationalisation Act (GINA) Act of 1972. Let us learn about non-banking financial company. A non-banking financial company is a company registered under the Companies Act 1956, engaged in the business of loans and advances, acquisition of shares, bonds, stocks, debentures, securities issued by government or local authority or other marketable securities of alike, leasing, hire purchase, insurance business, chit business, but does not include any institution whose principal business is that of agricultural activity, industrial activity, purchase or sale of any good other than securities, or providing any security services, sale, purchase, construction of immovable property. A non-banking institution, which is a company and has a principal business of receiving deposits under any scheme or arrangement in one lump sum or in an installment by way of contribution or in any other manner, is also a non-banking financial company. What are the functions of NBFC? Brokers of loanable funds, mobilization of savings, channelization of funds into investments, stabilize the capital market, and provide liquidity. These are the functions of non-banking financial company. A non-banking financial company is a company registered under the Act of 1956 or Act 2013 and carrying business of financial institution. Section 445 IC of RBI Act defines financial institution. What is included in the definition of financial institution is financing by way of giving loans, advances, or otherwise, acquisition of shares, stocks, bonds, debentures, or securities, hire purchase, insurance business, chit, QRIs, etc. business, money circulation schemes. And what is excluded? Agricultural operations should not be there, industrial activity should not be there, purchase or sale of any good other than securities, or providing any security, and sale, purchase, construction of immovable property. These should not be there in the company. What are the features of NBFC? It is registered with as RBI is mandatory. Registration with RBI is mandatory. All the NBFCs are not entitled to accept public deposits. NBFCs can accept public deposit for the maximum period of 12 months, minimum period of 12 months, and maximum period of 60 months. They cannot accept deposits payable on demand. NBFCs cannot offer interest rates higher than the ceiling rate prescribed by RBI from time to time. NBFCs cannot offer gifts, incentives, or any other additional benefit to the depositors. What are the types of NBFCs? The types of NBFCs can be divided on the basis of three. There can be three bases of division of NBFC: liability, size, and activity. On the basis of liability, these are deposit accepting and non-deposit accepting. On the basis of size, systematically important NBFCs are the NBFCs which are too important, too big, that if they fail, then the economy will be an issue. Non-systematically important NBFCs are small NBFCs. And on the basis of activities, we have asset finance companies, investment company, loan company, infrastructure finance company, SI-core investment company, infrastructure debt fund, microfinance institutions, factors, mortgage guarantee companies, and non-operating financial holding companies. These are all non-banking financial companies on the basis of activities. Let us compare between bank and NBFC. Bank is a government authorized financial intermediary that aims at providing banking services to the general public. An NBFC is a company that provides banking services to the people without holding a bank license. Incorporated under Banking Regulation Act, and this is incorporated under Companies Act of 2013 or Companies Bank of Act of 1956. Loan sanction process in banks is comparatively stringent. In NBFCs it is easier and faster. Demand deposits are accepted by banks but cannot be accepted by NBFCs. Deposit insurance facilities available with banks and non-available with NBFCs. Overdraft facilities available in some banks as SBI, and it is not available with NBFCs. Maintenance of reserve ratios is compulsory for banks and not required for NBFCs. Credit creation in banks do create credit. NBFCs do not create credit. Transaction services are provided by banks, not by NBFCs. And foreign investments allowed up to 74% for private sector banks and allowed up to 100% in NBFC. Indian mutual funds. A mutual fund is a type of investment vehicle consisting of portfolio of stocks, bonds, and other securities. Mutual funds give small or individual investors access to diversified, professionally managed portfolios at low price. The first introduction of mutual fund in India occurred in 1963 when the Government of India launched the Unit Trust of India Limited. UTI enjoyed monopoly in Indian mutual fund market until 1987 when the host of other government-controlled Indian financial companies established their own funds, including the State Bank of India, Canara Bank, and by Punjab National Bank. What are the features of mutual funds in India? Let us understand what mutual fund means. For example, if an investor wants to invest in stock market, he may not be able to invest because he does not have sufficient money to invest in stock market. What these mutual funds do, they collect it from all the investors, this small sum of money, and then they make it a huge pool of funds, and then they invest in the stock market and they try to make money out of it. They invest the benefits whatever has been accrued from the market fluctuations to the unit holders or in the mutual fund. They are managed by qualified experts. Open-ended funds are the funds which are open for subscription at any point of the year, and closed-ended funds have definite open period and closed period. Lump sum and SIP investments. You can invest in mutual funds lump sum at one go, or you can choose to go for systematic investment plans where you invest every month. No fixed returns are there, it is all subject to market risk. Debt funds are relatively safer because in debt fund you are not going for equity, which is more risky and is more prone to market fluctuations, but in debt fund you are getting regular interest payment. There's entry and exit load. These are commissions which are paid at the entry, at any entry in mutual fund or exit in mutual fund. There are tax benefits given by government. No TDS is deductible, and diversification of risk takes place in mutual fund because there's regular revision of portfolio, and portfolio is looked upon by the qualified experts. If you look into Indian mutual funds, by structure, there are three types of mutual funds: open-ended schemes, close-ended scheme, and interval scheme. Open-ended schemes are open for subscription throughout the year. Close-ended funds do have some opening date and closing date, and interval schemes are open within some interval time. By nature, equity fund, debt fund, and balanced fund. Equity funds are the funds which invest in the equity market. Debt funds are the funds which invest in debt instruments, and balanced funds have component of both equity and debt. By investment objective, growth schemes, equity funds, income schemes, debt funds, balanced schemes. So they are same as equity, debt, and balanced. And then we have money market schemes where you're investing in money market instruments like treasury bills, certificate of deposits, called money market. Other schemes are tax saving schemes, index scheme meant to replace performance of an index, and sector specific schemes. Tax saving schemes are the schemes which give you tax benefits. Index schemes are the schemes which are based on some index as underlying, and sector specific schemes are the schemes which are based on some specific sector like petroleum, gas, commodity, and some specific sector based schemes are there. Now, Indian mutual funds have some merits and some demerits. Let us look into the merits of the Indian mutual fund. Leads to liquidity, diversification of risk, expert management of funds, less cost for bulk transaction, cost efficiency, automated payments through ECS facility, suit your financial goals. Anyone can plan and start investing from today onwards. Quick and painless process. Tax efficiency, invest in smaller denominations, so you don't need to have a lot of money to invest in mutual fund. And safety, because your money is diversified and it is the hand of the professionals. Systematic or one-time investment. Now, what are the limitations or disadvantages of mutual fund? Mutual funds are subject to market risk. No guarantee of return is there. It is all on the basis of the movement of prices in the stock market. Division of portfolio does not maximize returns. Diversification of portfolio does not maximize returns. It minimizes risk. Selecting right financial security is not easy. It does require professional mindset, some kind of experience to select right financial securities. Cost management not proportional to performance. It is not proportional to performance. Cost, you have to pay entry and exit load whether you gain or lose. Unethical practice may creep in. We have come across a lot of frauds happening which do where these companies take up the money and then they suddenly just fly away from the market. Hidden or 12B1 fees of mutual fund. So there are some hidden charges or some 12B1 fees of mutual funds sometimes. So here we come to end of unit 1. I hope you all enjoy this session. We'll come with unit 2 soon. Thanks a lot.